on the slide there, transitory, as a lot of you probably already have figured out, refers to inflation, because the current, argument, if you want, the fight in the market right now is how much inflation are we going to see, and is this inflation a long-term trend? In other words, have we seen a change in trend, because the trend in inflation has been down for 40 years now, or is this just something transitory? Mainly because of this huge surge in activity coming out of COVID, all kinds of supply bottlenecks. It's an important question, because what happens with inflation will be a very important determinant of what happens with interest rates, and particularly real interest rates. And it really will sort of define returns for a lot of things. And I want to show you, I'll show you a table here in a second, but essentially, I talked about this actually at the last minute. I said, expect CPI to jump quite a bit in April, which it did. The biggest surprise to me, quite honestly, was that it was so much above consensus, because I don't know why anybody expected anything else. A lot of this was base effects. Basically, the price of everything, especially things like energy, crashed a year ago because of COVID, and you were just simply getting you're getting a comparison to a very low number last year. So you put a low number in the denominator, in the numerator, and you get a bigger percentage gain, and that's what happened. We'll probably see the same thing again in May. I'm not sure it's going to be as dramatic as April was, but when we see May CPI numbers in a couple of weeks, I suspect that's going to be a decent sized gain too. But we know a lot of that's base effects. We don't know how much of that is lasting, or whether we've started a new upward trend in inflation after 40 years of dropping. And it's important to everything. Take a close look at this. I know I shrunk a little more. I hope it's big enough on your screen, but take a close look at this chart. This is a very, very interesting chart to me, and it's really the basis of this whole talk, really. It comes out of this chart. What the table below shows you is relative returns with two scenarios. The dark scenario is when you have high, and they defined high as 3% inflation, with inflation rising, so trending upwards, or low, and in this case, it's below 3%, but it's also assuming a rising trend. So the light blue isn't even assuming deflation or flat. It's also assuming rising, just not rising as fast. And if you take a look, it goes left to right in terms of higher returns when you've got high and rising inflation. The highest one is oil. I mean, I think that's maybe a bit of a misnomer, I suspect, because oil is actually one of the drivers of it. So I think you're just seeing basically a loop effect there. Next one is S&P. That might surprise people. I've heard a lot of people talking about how badly Wall Street will do with inflation increases. I don't know where that comes from. If you get a sustained increase in inflation, these companies have pricing power, and they tend to actually have better margins. It's a little tough in terms of input costs, but by and large, the market does okay, as long as inflation can get totally out of control. The next one, of course, is gold, and that's what we care about. And these are monthly real total returns. So when you think about real total monthly return of about 1.2%, it's 1.4% almost. You take that out to a year, what that would mean from today's gold prices, gold like $2,400, something like that, a year from now. So I mean, this is fairly important stuff in terms of underpinning. So keep this chart in mind when we go through all this other stuff. What's driving this? Pretty simple. And again, this particular chart that I picked it frankly because it was a bit more dramatic. This is a fairly long-term chart. It goes back about 30 years, but it's the Fed funds rate, and that is the rate that the Fed sets. So this is not market bond yields. This is the Fed fund rate, the rate that they set at FOMC meetings, minus CPI. And as you can see, thanks to the move in the April CPI, the real interest rate just dived in the last 2 weeks. A surprisingly large amount, actually. And this tells you two things. One, how important right now inflation is as a component in driving precious metal prices and commodity prices. But it also tells you the simple fact that you're seeing this big of a divergence tells you that the bond market, I don't think, is really bought in to the whole, this is a permanent change in trend thing. I think bond traders largely think it's transitory. And this chart here, which is essentially the yield on the 10-year Treasury, kind of backs me up. I mean, you can see, obviously, coming out of last year's shit show, as things were strengthening, it kept moving up, which makes sense. If you're expecting higher growth, you're expecting higher yields, higher interest rates. Basically you're selling bonds, and that drives yields higher. It stalled out in March though, and interestingly, yeah, there was this little tiny move around the April CPI, but really it's not. It's really not much when you think CPI increased by about 1.5% that month. Bond traders obviously just shrugged at this. That they're obviously not really buying into the story just yet. Clearly, they still think we're dealing with something transitory, and really, at the end of the day, they're following the cues from the Fed. So even if they think inflation's going to, going to clink up in, tenth of a percent, fifth of a percent a month over the next few months, if they're not getting signals from the Fed saying the Fed is going to raise rates, you're probably not going to see them selling anything very hard, which means market bond yields will probably stay low, and that means real interest rates go even lower. And again, that's what we want as gold and commodity speculators. Same thing that happens with bonds happens with currencies. I mean, I've talked many times before about how there's no such thing as really as a currency in isolation. They're all pair trades. It's all compared to something else. And when you see a currency move into a sort of a time period where the rates turn really negative, I mean, essentially what that's saying is that currency in relation to its home interest rates will not be getting enough interest to cover and exceed inflation. That generally leads to selling of currencies, even the greenback, which is obviously the world's reserve currency. But even for the U.S. dollar, that has an impact. And again, you saw things really start to kind of bounce once we get out of 2020, and that this is really you could say this is sort of the vaccine bounce, the growth surge bounce everybody saw coming. But again, it rolled over beginning of April, and it's in a downtrend again. And this is because essentially the market thinks it is going to see rising inflation. You're not seeing that get matched with either market bond yields or the Fed. So you've got people trading out of the US dollar. I don't know really where this goes in the next little while, but it's quite possible this downtrend continues. I'm personally skeptical we're going to see the Fed do anything anytime soon. And of course, that leads us to our favorite, the gold price. Again, you can see it's still got a ways to go. It's not even really, gold's not, even though it's had a great move here in the last month and a half, but we're not even yet where we started the year at. And that was under conditions that were arguably significantly less favorable. Certainly the current negative yield environment is much stronger than the environment was at the start of the year. And of course, we're nowhere near where we were at the end of that huge run last summer. I do think it's probably moving higher though. I'm comforted by the fact that we've clearly broken this downtrend here. We've come out of that in the last week or so, and that it took a long time for us to get out of that. So I'm still pretty happy about where we are. I'm happy about the way stocks are starting to react to good news in the gold space, and I'm also happy that there's still lots of bears out there. There's lots of you still own gold, not Bitcoin. Have fun being poor. I'm happy to see all that stuff. That's what I want to see. What I don't want to see is my Twitter feed full of people saying gold's going to $10,000. That would scare the crap out of me. I'm not seeing that yet. The sentiment, I think, is still overall a bit bearish, which is exactly what we want. That tells me we've got more upside. So, essentially what we're dealing with here is, I think precious metals have the all clear. I think base metals do too, although there's one little niggling concern I've got, and I'll get to that in a couple of slides. But essentially, as long as the market considers that inflation is going to keep increasing, if that's the market consensus, gold and commodities can keep moving higher. The 1970s is obviously the classic example, but the same thing happened in the 2000s. We did see yields rising along with the economy through the mid 2000s, and it didn't do the gold price any harm at all, nor any other base metals. And that, it doesn't mean things are going to be straight up though, because we're going to see reactions. I don't think the inflation question is decided by the market yet. I think the fight's still on here, frankly. I'm personally on the fence still, to be honest. I'm not convinced that a lot of this inflation increase is not in fact transitory. I think we're probably going to see it start flattening out. as we move through say Q3 and basically when things fully open up across enough economies that it starts fixing some of the bottlenecks, because I do think that's a big problem. I look at things like lumber, and I think bottlenecks are as much a problem as demand. Well, demand's obviously up. Long term, I think things are fine for this, but we'll get some bouncing around as things move up, depending on monthly CPI increases, monthly um, purchaser managers index, and obviously what the Fed says at meetings. We saw a bit of a downward blip yesterday, and that was simply the Fed meeting minutes from last month coming out, and the Fed saying that they were thinking about tapering, and that was enough to spook people for an hour. So I mean, I think that's something we have to watch. But my opinion of what's going on with the Fed is, and I again, this is sort of like the reaction to the last CPI. I mean, I don't quite understand why this isn't consensus. But if you listen to what the Fed, the FOMC members have said for the last 6 months, really, not what they do, what they say. If you look at their comments in numerous interviews, numerous articles during the Fed meetings themselves, in the minutes, they made it abundantly clear that the Fed is going to lean hard on the full employment part of their dual mandate, not the sound money part, the full employment part. That is far and away their most important concern. And there are some reasons for that. I don't have time to go into it today, but if you pull up things like labor participation, it's really impressive how much unemployment rates have dropped. But the truth of the matter is, there's still several million jobs missing from pre-COVID. Labor participation is still quite low. The U.S. has a funky way of doing unemployment numbers where it's really a function of how much participation you've got. You can have a lot of people out of the workforce, but if they're not looking for work, they're not counted as unemployed. So, and the Fed's well aware of that, and they've said over and over and over again that's going to be the main part of their mandate. So I think the Fed's going to need to see a real inflation move. I think they would need to see inflation rising for, say, I don't know, a year from now into 2022 at least, before they started thinking to themselves, okay, this isn't transitory. Maybe we should do something. And even then, I think they're only going to do it if you've seen a significant decrease in the unemployment rate. That is their mandate. It's pretty obvious. Obviously, what's been good for gold has been good for all commodities, really. I mean, if you go back to the 70s, it wasn't just gold that did great. Commodities right across the board did really well. And it's no different this time. Here's a copper chart, and that's a hell of a chart, folks. That's a really, really impressive chart. Lower left, upper right. There's nothing not to like about this chart. And if you look at zinc, if you look at lead, if you look at bulks, especially things like iron ore, softs, wheat, corn, pretty much everything is looking like this right now. And that is what you expect. And it is an argument for people that say, no, this isn't transitory, it's the real deal. This is what charts look like when it's the real deal. The one thing I would say, though, is in the case of metals, and I think it's certainly true with copper, I think it's maybe less true with nickel, but you do have some supply chain issues here. There are transportation issues across the globe. The whole transportation infrastructure was cut back quite a bit before COVID came along. It really hasn't been built out again. There are still a lot of issues with COVID in parts of the world where this stuff actually gets produced. Everybody thinks of, okay, we're past the bad stuff. Almost everybody's vaccinated in the States. They're getting it really fast in Europe and Britain and Canada. But that's not where this stuff comes from. Most of it comes from places like Peru, Zaire, Congo, places where, and other countries in South America that are still having a lot of problems with COVID and are still fairly locked down by and large. So we do actually have supply issues here. This isn't strictly a demand story, but I do agree with people that take a longer term view on this and say, base metals, especially the energy metals, if you want to call them that, copper, nickel, tin, a few things like that, that they're going to have a great decade. I'm a little bit surprised at how big the numbers are coming out of some of the investment banks that are talking prices that seem insane to me. And I think prices where we will see We will see some demand shock if if copper goes to $6 or $7 or $8 quickly. Don't forget that there's a lot of things that you need copper for, but there's actually a lot of big uses for copper where aluminum will work. It doesn't work well, but it works. And if the price of copper is 10 times the price of aluminum, you'll see some switchover. We saw that 30 years ago where a lot of wiring went to aluminum. It's not good and it's a fire hazard, but it is what it is. If there's that much price difference, you'll see it happen. Long term, even medium term, I'm super bullish on this stuff. The only concern I have, and I'm not trying to be Debbie Downer here, but let me just go to this. Is this chart gives me a little bit of pause, and I'll explain what this is. This is a comparison going back about 13 years. The light shading that you see on there is just it's the Bloomberg Commodity Index, and it's a year over year change. So it's a percentage change from the year before. That's what's being traced in this graph. So that's the light blue here. The dark blue is the China credit impulse. And what the credit impulse is, essentially it's new lending, it's growth in lending. Credit impulse measures the growth in lending in relation to the GDP. So essentially, the higher the credit impulse is, the more credit is being created, the more money is flushing through the market. I don't think it's any secret to any of you that China runs on credit. Bank credit is a huge, huge function in how quickly their economy is growing, what the levels of investment are, and what the levels of speculation are. And if you look at this part here, there's a divergence like we've never seen before, and I'm not sure what to make of this, quite honestly. This is something that's really showed up in the last few months. There has been heavy buying out of China of pretty much all commodities, iron ore really heavy, copper really heavy. It may simply be that China is being ahead of the curve because they often are with this kind of stuff where they're saying, yeah, it's not that hard to get copper now, but it's going to be hard in 5 years. It's not that hard to get iron ore now, but it's going to be in 5 years. So we're just going to buy the crap out of this stuff and we'll just stuff it in warehouses. And then we'll have it on hand when everybody else has a problem. I don't know how much of it's that or how much of it's just pure straight up speculation, but I do, I'm not trying to sound negative about base metals because I'm not negative at all. But this is something I'm going to be keeping an eye on going forward because I simply don't understand why this divergence is that large. It's odd. So, just to do a very quick summary, basically, I think precious metals have the all clear here. Yeah, they're going to bounce up and down, but I think going higher is the way things are going to go. I think that's true of base metals too, notwithstanding the comments I just made. Although some of them are getting to prices where there may be some substitution. The one thing that's going to help, I use the word help sardonically, is that we're clearly going to see an increase in difficulty in a lot of different jurisdictions when it comes to one, permitting, and two, how much money they want to get out of the companies that are mining. Chile's been talking much higher taxes. Peru's been talking much higher taxes, though we have to see what happens with the election. But essentially, and this is something, I've seen this movie before. I saw it in the 70s. I saw it in the 80s. Whenever miners have a really good run, when metals go up for several years in a row, and mining companies that have been basically eating out of the alley for the last few years are suddenly making tons of money. Sure as clockwork, politicians want to try to take as much of it as they can. Not really sure why everybody hates this, but apparently they do. So, while those are not things I would call nice, those are positive factors in terms of price, because the more it slows down mine building, the more it slows down the permitting and development process, and the more certain jurisdictions become basically no-go zones for investment, the slower these guys are going to be growing production. And that's not fun for the mining companies, but it's better for us because it gives us a better backdrop. So I think barring something right out of left field, I think we're going to have some fun.